Greetings of the day. In this video, we will see an extended problem related to debtors management. The question has something new which we have done in the earlier video. It has a new concept of bad debts in it. Bad debts are those payment which is not recovered from our debtors to whom we have made and credit sales. The question has two new things or one new adjustment of bad debts which we will deal in this video. The question says that a company known as Good sells 40,000 units yearly for rupees 50 per unit with an average cost of 40 and variable cost of rupees 30 per unit respectively. Average collection period is usually given 60 days, that is in existing policy, whereas in proposed policy it is been suggested to reduce it to 45 days so that they would be more easy to collect and reduce the amount of debtors. The bad debts losses at present are 3% of the sales, whereas collection charges are 20,000. Collection charges means what we can say realization cost, or we can also term it as administrative expenses. In new policy, the bad debts can be reduced from 3% to 1% when the collection period drops from 60 to 45. The cost of whereas it has also a negative effect. From 40,000 units we would have reduced to 39,000 units as impact of the strict credit policies of the company, whereas the collection expenses would be in proposed policy of 30,000 which was earlier 20,000 in the present policy. The company is required to have 17% return on their capital, and we are being said to advise the company which policy we should accept, whether of 60 days of existing or proposed policy of 45 days. In absence of any information with related to the number of days or month in a year, we can know in an year there are 12 months, we can take it standardly. In case of days, we have to make an assumption that as the question says that question does not have the total number of days in a year, we would assume it 360 or 365. We can take eitherly. In this question it was clearly given there are 360 days in a year, so we can move with the 360 days. First of all, we have to take credit period, particularly in days. In existing policy it is 60 days, whereas in proposed it is been reduced to 45 days as strict credit policy was introduced. Whereas sales in units, we can see that at present we are having 40,000 units, whereas in proposed it would be reduced by 1,000 units. It means that we have 39,000 units. Then sales in rupees, number of units multiplied by selling price, that is rupees 50 per unit, rupees 50 per unit. Therefore 40,000 into 50 would equals to 20 lakh. 20 lakh. In proposed 39,000 into 50 would equals to 19 lakh 50,000. 19 lakh 50,000. Now variable cost, it changes with the changes in the production, hence number of units into variable cost per unit was given of 30. Therefore 40,000 into 30, 40,000 into 30 would equals to 12 lakh, whereas in the proposed policy as the production has been reduced, therefore 39,000 into 30, 39,000 into 30, it would be equals to 11 lakh 70,000, 11 lakh 70,000. Till here everything is quite simple and easy to understand. Now the thing becomes a bit tricky in case of fixed cost. Usually fixed cost is not directly been given in the question. What we have been given average cost. In this particular question also we have been given average cost of rupees 40, whereas variable cost we know that it is of 30, hence 40 minus 30 equals to 10. This is our fixed cost multiplied by number of units at existing position is 4 lakh, therefore 10 into 4 lakh is equals to 10 into 40,000, I am mistakenly said for 4 lakh. 10 into 40,000 would equals to 4 lakh. This is our fixed cost. 4 lakh is our fixed cost. It would be same in both the cases, in existing level also, in proposed level also, because due to the decrease in the production of 1000 units, it would not impact the fixed cost. Now we have to calculate total cost 12 lakh, that is B plus E. 12 lakh plus 4 lakh, 16 lakh. Whereas for proposed policy it would be 15 lakh 70,000. 15 lakh 70,000 70. Now we have to calculate debtors. What formula we have said that total cost multiplied by credit period divided by number of days in a year, that is 360. Total cost 16 lakh into number of credit period allowed 60 days divided by 360 is equals to 2,66,667. 2,66,667, whereas the proposed policy 15,70,000 into 45 divided by 360 is equals to 1,96,000. 1,96,250. Now we have to calculate opportunity cost. What was the formula for calculation of opportunity cost? Debtors multiplied by cost of capital. Debtors we have calculated for both the policies. Cost of capital was given in the question at the rate 17%. So we have to take, that is 2,66,667 into 17% would equals to 45,333. 45,333, whereas for proposed 1,96,250 into 17% would equals to 33,363. 33,363. Now when we come to realization cost, we have already stated that it is already been given in the question. For existing level, we can see that there was an collection charges of rupees 20,000, whereas for proposed level it would increase by 10,000 to 30,000. It was already been mentioned in the question by name of correction charges or administrative expenses or office expenses. We can take it. Now coming to the new portion in this solution, that is of bad debts. At present, due to the liberal credit policy, we have 3% of bad debts, whereas in the strict credit policy it can be reduced to 1%. It is usually given in percentage of sales. Now we have to calculate bad debts in amount, that is in rupees. The formula is quite simple. Sales multiplied by percentage of bad debts. For existing level, our sales amount was of 20 lakh multiplied by 3%, that is 60,000. Whereas for proposed sales amount was 19,50,000 into 1%, that is 19,500. This is our bad debts in rupees. Now we have to calculate profit. The formula for calculation of profit is sales minus total cost. Sales was of 20 lakh, total cost of was of what we can say 16 lakh. Therefore profit is of 4 lakh rupees. 4 lakh rupees. For proposed level, sales is of 19,50,000, whereas total cost is of 15,70,000. Therefore profit is of 3,80,000. 3,80,000. This is the profit at both the policies. We can see that it has been reduced by 20,000. Now coming to the net profit, that is profit minus opportunity cost minus realization cost, and now bad debts also. Therefore 4 lakh minus 45,333 minus 20,000 minus 60,000 would equals to 2,74,667. 2,74,667. In proposed policy, it would be 3,80,000 minus 33,363 minus 30,000 minus 19,500 would equals to 2,94,137. 2,94,137. So this was the solution. What we have seen is at the level of only profit, the profit of proposed policy, existing policy was good as compared to the proposed policy, but when we deduct all other costs with the profit and calculate the net profit, what we can see, the proposed policy is much better as compared to the existing policy. Hence, at the end of the solution, now we can draw the recommendation that it is recommended to adopt the proposed credit policies of 45 days, as it has increased our profit from 2,74,667 to 2,94,137, that is by rupees 22,400 what we can say 70. That is why new policy, a proposed policy should be accepted. This was it for this video. In the next video we will see something new. Till then, stay tuned. Thank you.